You probably have heard investment opportunities give an asterisk saying past performance is not a guarantee for future results. And this is very important, and it's usually given as a disclaimer to caution investors from getting overexcited about an investment opportunity just because the recent performance was strong. For example, let's say a hedge fund is recently doing super well. So over the last year or something, they've been delivering 30% returns. And of course, you might say, well, past performance is no guarantee of future results. And so just because they did 30% last year doesn't mean they'll do 30% next year. And this is true, and it's good advice. It's good to be conservative and understand that just because one year's really good, it's not going to be like that all the time. The funny thing is, though, is people usually don't think about this in the reverse, because it's also true that past performance does not predict future results, especially when talking about negative results. So if an investment strategy or some sort of opportunity has been doing poorly over the last 6 months, year, 2 years, what have you, it's not a predictor that it's also going to be bad in the next year, 2 years, and so on. And actually, whether it's up or down, it can actually be a predictor of the opposite. So for example, if the market is really high and for example, single-family homes have gone up in price so much over the last 5 years. If you look around, near where you live, the average is probably way above historical norms going back 100 years. So it would be aggressive to assume that you would get housing price appreciation over the next 5 years equal to the previous 5 years. And if anything, you're almost borrowing from future performance when results are so good, and you could expect actually the next 5 years to be pretty weak in terms of housing price appreciation, if nothing but just because the previous 5 years have been so strong. So on the flip side of things, if you look at industry or an investment strategy that has languished over the previous 1 to 5 years or whatever your outlook is, you might say, oh wow, this has been depressed for a long time, and actually over the next 1, 2, 3, 5 years, we're looking at a better upcycle. And so this is a concept that I found interesting. For example, Goldman Sachs recently published a report that the stock market has been doing super well over the last very long time, and that based on their analyses, if they just anticipate over the next 10 years the market to kind of react to certain metrics and fundamentals, you should really only expect to make around 3% per year on average over the next 10 years investing in the stock market. And why? It's because the stock market has averaged nearly 20% over year over the last 10 years, and that's just simply not sustainable, and you're borrowing from somewhere. And so in this case, they're arguing that you're borrowing from future performance. So when we're looking at our business of multifamily investing, we've seen that things have been pretty stagnant. Things have been even depressing at times, and we haven't seen much appreciation or rent growth over the last 3 years. And this actually, funny enough, is a sign to be excited about, and that over the next few years, 2026, 2027, 2028, we're likely to see undersupply, and we're likely to see very strong demand, which is going to push rents higher, which is going to get more investors interested into the asset class, and that's going to create a positive upward spiral of price appreciation, cap rate compression, and so on and so forth.